Good morning, members. We welcome you at a very early morning on our first session for this month of July 2022. After the grand success of our yesterday's mega blood donation and the health checkup camp, wherein the lot of members and their family members, their friends and relatives have taken the benefit of this camp, and the way the members came forward for the donating the blood, the numbers were high. And many members were being rejected because of hemoglobin and all those issues. Now, before we start our today's first sessions, it is on the NRI taxations, and we have with us very eminent speakers here, Vyomesh bhai Pathak. We welcome Vyomesh bhai for accepting our invitation with a round of applause. So before we start our today's sessions and we go towards the formal introductions of today's speaker, we'll play our Institute motto song, and we request all the members to please rise and go. Play one national anthem. Thank you. So now it's a time to have the formal introduction of our today's speaker. So for that, I would like to invite our Con Group member, say Manish bhai Deria, will introduce to the today's speaker.
Thank you, convener, for giving me this opportunity of introducing today's speaker. Before I start, Can I request all members to come forward and take the benefit of the session of today's? The topic for today is international taxation, one of the upcoming field for our chartered accountants, for which to guide on and through enlighten us, we have Associate Director of BSR CA Vyomesh Pathak with us. He has around 12 years of experience in corporate tax and advisory compliance matters. He is a regular speaker at various forums of WRC, CTC, and others. He is on committee of CTC, various committees of CTC, and a vice chairman of Law and Representation Committee of CTC. He is on the committee of international taxation of WRC of ICAI. He has been a regular contributor to various articles of various articles in CTC and AIFTP journals, ITAI, online.org, etc. He is a regular contributor to WRC referencer from 2016-17 onwards. He has co-authored Compendium of International Taxation published by CTC. He has co-authored a book on ICDS released by CTC in the month of June 2017. He has been assisting CREDI in preparing pre-budget memorandum, which is being represented to Finance Ministry year on year. As an extracurricular activity, he has a novel knowledge on numerology and Vastu consultancy and tarot card reading. The fees which he charge is being used for social cause only. So with this small introduction, I welcome Vyomesh bhai to this August gathering. Now I request Purvi Bagheria, Deputy Convener, and Rahul Daga to present a small memento as a token of love and affection to the speaker.
नहीं सर अभी संडे ठीक है मेडिकल तो शेयर स्क्रीन किया नहीं क्या हो गया शेयर स्क्रीन नहीं हो रहा है क्या
बाकी सब विंडोज को बंद कर दो पहले
नहीं ये बोला जूम पे जा पर शेयर स्क्रीन नहीं हो रहा ना इसको ऐसा करो क्या नहीं वन बार ऐसा करो शेयर कर
इसमें भी इंफॉर्मेशन देना होगा
सब करना kitchen go just one thing yeah just doing that one I think this is fine yeah good to go zoom होता है चाहिए बोलो मैं नहीं ठीक है चलेगा
All right. Good morning, everyone. So at the outset, let me thank the convener, deputy convener, co-convener, and the team of JP Nagar Study Circle, and of course Seema Madam, the past convener, for inviting me. I think this is third time or fourth time I'm interacting with JP Nagar, but first time physically. So thanks to COVID. And of course, the topic for today's discussion is taxation of NRIs in India. So if I go back in history, say 4 years, 5 years down the line, I would have said that this is an upcoming topic. But today, let me tell you, this is no more an upcoming topic. This is a current topic. The reason being, in each and every family, I would say, forget about outsiders, you will have one or two non-residents or NRIs. Either your kids studying overseas or working overseas, or your nephews, niece studying overseas, or maybe doing job overseas. So this is no longer a topic wherein you can say, "Okay, if I don't know, it's okay." Because what happens is, once I am a chartered accountant, right? The expectations from everyone is like, you should know everything. You should know GST, you should know international tax and everything under the sun. And they come to you for guidance कि ये इतना टाइम इतना दिन इंडिया में था, इतना दिन ओवरसीज था, मेरा कौन सा इनकम टैक्स होगा, क्या होगा. And if you go back and say कि boss, I don't do international tax, आपके मुंह पे कुछ नहीं बोलेगा, but then बाद में घर पे जाके यार ये इतना साल से आता नहीं उसको कुछ. On a lighter note, but that is the fact of the life, that the number of NRIs that we deal with as compared to earlier has increased day in, day out. So therefore, even as I said, we need not go outside to fetch non-resident clients or non-resident taxpayers. Within our family itself, you will find few of them, if not more. So therefore, I would say that this is the current topic and of utmost importance. And of course, if I look at it from the practice perspective also, to be honest, nothing is left in the traditional practice as far as from the income earning stream is concerned, right? So therefore, what is relevant for us is to get hold of the niche practice areas, and also look at the various opportunities where practicing chartered accountants can get better revenues in terms of the fees, etc. So this is again one of those fields which will give you that opportunity both to practice in something different, and of course earn from non-residents in foreign currency. So from both the perspectives, I believe that this is not because I am dealing with this topic, but I genuinely believe that this is one of the more relevant topics as of today. So the way I plan to proceed is, we begin with the basics, that is the residential status, of course, and then we move on to the specifics of the NRI taxation. Of course, in 2 hours, I cannot cover the entire, even a full day will be less to cover NRI taxation. And of course, we don't want to be expertise in NRI taxation in one day. It is not possible also. So I am just trying to cover the key aspects of what will be relevant from the NRI perspective, that is the taxability of capital gains, house property income, dividend income, royalty, FTS, etc., and few basic concepts of international tax and the tax treaties. And towards the end, of course, I will cover the most relevant part, that is the certification aspect, that is 15 CACB, which is relevant from the practicing chartered accountants point of view. And that is how I plan to proceed in the session in the given time frame. I have a lot to cover, so I'll go a bit, not fast, I would say, but at a gentle pace. So if any queries, etc., stop me there. And don't wait till the end, because maybe towards the end we may or may not have time for Q&A. So I'm okay to take questions even during the session, quite flexible. So we come to the residential status aspect, and why I'm covering this, because there has been a change by Finance Act 2020. So therefore, the assessments of that particular year will be opening up now. So therefore, I thought it is relevant for us to also brush up on the recent changes and developments in the residential status and then move on to the specifics. So as you all are aware, specifically section 6 deals with the residential status, and we basket the individual residential status into resident and non-resident, and within resident we have two categories: ROR, that is resident and ordinary resident, and NOR, that is resident but not ordinary resident. Now all of a sudden this NOR category has gained a lot of importance very recently. So therefore I thought that let me touch upon this to begin with, and then we go to the other specific aspects. So the basic conditions, as we all might be aware, which were there before the budget, before this amendment, was 182 days or more during the relevant financial year. That is the physical stay in India, of course. Or the second condition, if I don't satisfy the first condition, I move on to the second condition. 60 days or more in a financial year, plus say 65 days or more in the preceding 4 financial years. This was the basic condition prior to the amendment. Of course, this second condition, that is 60 days or more, is being replaced by 182 days in certain specific categories. That is, if I am leaving India for employment. So for example, if I am an Indian citizen and I am leaving India for the purpose of employment, then in that particular case, I need not look at 60 days, I have to look at 182 days, right? So effectively, if I don't satisfy the first condition and I'm going on employment from India, I need not look at the second condition, because ultimately second condition again takes me back to 182 days.
So here the employment takes into account the person going on a business visa also?
Yes. So employment includes self-employment also. So therefore, there are a few judicial precedents which have also said that, because earlier, of course, there was a gray area that when I say employment, it has to be a job only. But practically speaking, employment includes self-employment also, arguably. Again, for citizens and PIOs, 60 days was also replaced by 182 days. If you see that in red, the reason it is in red is because the amendment is here. In the year of visit to India for citizen of India PIO while being outside India. So assuming I am an Indian citizen or a person of Indian origin, that is either my parents or grandparents were born in India, then I am coming to India on visits, either to meet my family or just generally for visit. And my stay, again in that case, also the condition was 60 days getting replaced to 182 days, right? If I look at the additional conditions for getting ROR, so I have to be resident in India for 2 out of 10 preceding years, and I have to be in India for 730 days or more in the 7 financial years preceding the relevant financial year. This is the additional condition. If I satisfy both of these, then I am a ROR. If I don't satisfy both of these, that is, if I satisfy either one or none, then I am NOR, that is not ordinary resident. Now, just to give you a background, this 182 days for person coming to India on a visit, as per the government, it was being misused by various individuals, and they used to plan their residential status in such a way that they become non-resident in India. For example, I come on frequent visits to India. I stay in Dubai or I stay in USA or wherever. I come to India frequently, but I ensure that I am not in India for 182 days. I am in India for 175 days, 178 days. Literally, as in people used to do those calculations and ensure that they are not a resident in India. They have substantial income in India, but they plan their residential status in such a manner so as to avoid the taxability of their particular income in India. So to plug this particular misuse, the government has brought in this particular amendment by Finance Act 2020, wherein it says that for citizens of India or PIO who being outside India come to visit the residency is triggered with the reduced period of 120 days. So the extended number of days of 182 days which was available, now that has been reduced to 120 days, right? So they have reduced it by 62 days. Test for qualifying as NOR, that also has been truncated, that is 7 out of 10 preceding years, and the test of 730 days was proposed to be deleted, but that has not been done, to be honest. Then citizen of India not liable to tax in any country by reason of his residency, domicile or similar criteria, he will be deemed to be resident of India. So this was another planning which people used to do, is that they used to stay in multiple countries in such a manner that they don't become resident of any of the countries, right? So thereby not paying taxes anywhere in the world. So even they are trying to catch hold of these situations also, where while I am citizen of India, but I am not resident of any of the countries, nor India, neither India nor any of the overseas countries. Then subsequently, they brought in, because there was a lot of hue and cry specifically from the Middle East, Dubai, etc. Because as such, there is no taxability in Dubai. Individual taxation was not there. Even today we have corporate tax, but individual is not yet there. So they were genuine employees in the Middle East, but because of these tax regime there, they were not particularly paying taxes there, because there is no tax as such. So therefore, the government brought in this circular or clarification by way of a press release rather, that no intention to tax those Indian citizens who are bona fide workers in other countries, including Middle East, etc. Foreign income will be taxable in India only if such income is derived from a business or profession in India. So this is a relief, or rather a clarificatory relief which they have given to genuine workers or employees in the Middle East, etc. So as I said, what changes from 60 days, the second condition, that is the B, which was 182 days earlier, now that has been truncated to 120 days. Of course, my income has to be more than 15 lakhs in India, so as to qualify as a resident in India, so as to qualify as not ordinary resident in India. So what changes is the second condition. 60 days will now be replaced by 120 days and not 182 days for those people who are coming to India for visits. For those people who are coming to India for visits. So here, post enactment, if you see, 120 days, but what is also relevant is 15 lakh income. So assuming my income is less than 15 lakhs, but my stay is say 140 days, will I be a resident or will I be a non-resident? If my number of days stay is 140 days, but my income is 10 lakhs, my income which is earned from India is 10 lakhs. So will I be a resident or a non-resident? Resident? Resident? Sorry? What is? But below 15 lakhs. So let us look at this snapshot. This covers this flowchart covers in one slide. So assuming I am present in India for more than 182 days, then automatically I become a resident. No questions there. The only issue will be here on the right hand side, extreme right. Present in India for more than 120 days. Right? I need to check whether my income is more than 1.5 million, that is 15 lakhs. As simple as that. So two conditions, more than 120 days, more than or equal to 120 days, plus my income also has to exceed 15 lakhs. See, let us look at the reason why this amendment is being brought in, right? This amendment is being brought in to catch hold of those people who have substantial income in India, but they are not paying taxes by planning their residential status. So this is not for the small taxpayers who might have some interest income, some dividend income, some capital gains from mutual funds, equity shares, etc. in India. And they are coming to India for 160 days, 170 days for genuinely visiting their families, etc. This is to catch hold of those big taxpayers who are planning their residential status, and therefore the 15 million criteria, the 1.5 million criteria is also there. So if my stay in India is more than 120 days, but my income is less than 15 lakhs, I continue to be a non-resident. I continue to be a non-resident. Right? So let us look at a case study, that is, let us understand by way of an example. Mr. A, who is business head for Asia Pacific of an MNC overseas, he has to travel to various locations for business purposes. He has spent 200 days traveling in 2021. So if I reduce 200, effectively I am in India for 160, 165 days. Also, he has been traveling abroad from past 2 years and has stayed out of India for 400 days in this previous year. So effectively 365 days condition is not satisfied. So if I look at the basic condition, I am in India for more than 182 days, not satisfied. Second condition, 60 days or more is satisfied. 365 days or more is satisfied. Additional condition, if I look at it, 2 out of 10 satisfied, 730 days also satisfied. Now here the moot question is, this 60 days will be replaced by how many number of days? 120 or 180? Sorry? 120 or 180? Yeah. He's an Indian citizen. Right? 120 or 180? See, what we need to understand is whether he is gone outside India for the purpose of employment. That is what we need to see. Is he going outside India for the purpose of employment? In this case, his employment, while he is Asia Pacific head, his employment remains in India. Right? So therefore, we need to check whether he is going outside India for the purpose of employment. So therefore, in this case, assuming his employment is in India, 60 days will continue to be governed. If he is going outside India for the purpose of employment, then it will get replaced to 182 days. Right? Second case study. Miss Poo went to London to join a reputed university for graduation course. A typical Indian scenario, 3 years education course. While studying there, her professor suggested her to join a postgraduate course in the same university for 2 more years. She had to get an internship certificate to complete the course. Upon completion, the firm offered her a permanent position. She has been an employee there for the past 4 years. So she has stayed out of India for 9 years now. For 9 years, she is out of India. She receives rental income from the property which is inherited from her parents. Right? So now here she is outside India for the purpose of employment. So here the 60 days will be replaced by 182 days. Right? So if my first condition, that is the basic condition, is not satisfied, my second condition also automatically will not be satisfied. So therefore, I will be a non-resident. Right? Third case study. This is on visits, I believe. Miss B, a person of Indian origin residing in Canada, and doing the job there, visits India regularly to meet her parents. During the relevant year, her stay in India for all the visits is 135 days, right? That is more than 120 days. She earns dividend income and interest income from her investments in India. During the financial year 2021, she has earned 16,50,000, that is 1.65 million. Now, if I look at the basic condition, my residential status 60 days gets replaced by 120 days because I am coming on visit to India. My number of days stay in India is 135 days. So therefore, I satisfy that condition. Second condition of 1.5 million, again, I satisfy that condition because my income in India is 16.5 lakhs. So I become a resident, but not ordinary resident. Right? Now, had this income of 16,50,000 be 14,99,999, right? Then what would be the difference? She would be a non-resident. She would be a non-resident, right? So both the conditions must be satisfied for the new 120 days criteria to get triggered. Otherwise, 60 days and 182 days, which was there earlier, will continue. So basically, the 182 days benefit or extension which was given to the so-called non-residents is now being truncated to 120 days, specifically for those people who are coming to visit in India. The residential status. Why residential status plays an important role is the taxability. As far as the resident is concerned, the global income is chargeable to tax. We all know this as a known fact. Because if I am a resident, does not matter in which country am I earning the income from, the entire income will be charged to tax. Now, if I look at the non-resident, what is the income which will be chargeable to tax? That is income received or deemed to be received in India, or income accruing or deemed to be accruing or arising in India. That is section 9, etc. So just a snapshot, ROR, again, global income will be chargeable to tax. NOR, that is income sourced from India, income received or deemed to be received in India, or income derived from business, control or profession set up in India. If I compare NOR with NR, that is non-resident, income sourced from India and income received or deemed to be received in India, right? That is, first two bullets are same for NOR and NR. What additional income is chargeable to tax in case of NOR is the income derived from business, control or profession set up in India, right? That is an additional source of income which is taxable in the hands of the NOR. So what is the difference between NOR and NR is additional income which is chargeable in the case of NOR is the income derived from business, control or profession set up in India. What do you mean by income deemed to accrue or arise in India quickly?
Which rule we will see person coming from outside India, outside for an employment. Generally for MNC companies, some companies do.
Yeah, so this is for a non-resident, the reverse case scenario where I'm coming to India for employment in India as a originally I am a non-resident. So for example, I am employee of a German multinational and I'm coming on deputation to India for the Indian subsidiary or the Indian group company or whatever. So in that case, I have to look at the basic criteria, that is 182 days or more, or 60 days and 60 days and 365 days, etc. Same rule, basic rule. So section 9, if you look at it, a snapshot, that is income deemed to, this plays very, very important role because income received in India is very clear. Income accruing in India is very clear. This is a deeming fiction which looks at the source. This is the source rule. I would say that if the source is in India, then irrespective of where I am receiving it, it will be taxable in India. So if you look at 911, we typically call it as business connection. I'll deal it with in the subsequent slides. That is, if you have a business connection in India or property or asset or source of income in India, or transfer of capital assets situated outside India, that is indirect transfer cases. I'll cover this by way of a case study and example. 912, that is salaries earned in India. 913, salaries payable by government for employees sent outside India. 914, dividend income. 915, interest. 916 and 917, royalty and fees for technical services. These are the two, I would say, categories where you might be facing from the payer perspective, that I'm making a payment for royalty, I'm making a payment for FTS, I as in our client, whether the tax is to be deducted, whether TDS to be deducted, if yes, then what rate, etc. So we'll cover those specific aspects in the subsequent slides, because this is covered by the deeming fiction, and you also need to look at the treaties for this particular, for taxability of this particular income. Indirect transfer, again, as I said, this is a recent development wherein the government has introduced post the Vodafone ruling, that if you have any transfer of capital asset which is outside India, right? For example, you are transferring shares of a company which is registered in, say, Mauritius or a Singapore, right? I am transferring shares of a Mauritius company. Effectively, I am a non-resident. Okay. I am transferring these shares of Mauritius company to another non-resident. Technically speaking, both are outside India. The shares of the company which is being sold is also outside India. So if you look at it from an overall perspective, generally this should not be chargeable to tax from the jurisdictional perspective, right? Because India cannot have jurisdiction over other countries to charge tax. This was a typical case in the Vodafone ruling Supreme Court, where where the Supreme Court ruled in favor of the assessee, saying that this is a transfer which is outside India, so therefore extraterritorial jurisdiction should not trigger. And after that, they brought in this amendment of indirect transfer. It means if you transfer the shares of an overseas company or a foreign company, if that company has assets based in India, for example, more than 50% of its total assets in India, then proportionate to that, the income will be chargeable to tax. So for example, this Mauritius company, out of its total assets, has 60% of asset base in India, either by way of equity shares or land building or whatever, right? In that case, it will be chargeable to tax the capital gain, right? Because transfer of shares pe kya hoga? Capital gain. So that capital gain will be chargeable to tax in India, because majority, that is substantial, the words which I have used is directly or indirectly derives its value substantially from the assets located in India. So therefore, if you have substantial assets in India, that is more than 50%, then that will be chargeable to tax in India, even if the shares of the company which are being transferred are not in India. The situs is outside, even though they are saying a deeming fiction will apply and it will be taxable in India. For 911, we also have business connection, property, assets, and source of income, which we just discussed earlier. So what do you mean by business connection? Business connection is basically prior to bringing in the amendment of or introduction of the concept of permanent establishment, we had this concept of business connection, or BC 911, right? This is a wider concept as compared to a permanent establishment, right? Permanent establishment, or PE as we call it, which was introduced later on. Transfer pricing provisions जब इंडिया में आया तभी permanent establishment का concept इंडिया में आया. And even if you look at the definition of permanent establishment in India under the Act, it is an inclusive definition. It does not give you a specific meaning of what I mean by PE. So prior to the PE cases, we still have the business connection. Now, for those cases where we don't have treaties, right? For those cases where India has not signed any treaty, the concept of business connection becomes more important, because you don't have a treaty protection there to safeguard you from the definition of the narrow definition of permanent establishment. So it is Indian equivalent of permanent establishment, and as I said, it has wider scope. The basic concept is that a non-resident person should be liable to tax for profits earned in India if he has real and significant or substantial economic nexus. The term which is significant is, this is specifically for international transactions. Real and intimate connection, right? You should have a real connection in India between a non-resident and the activities within India. The relation contributes directly or indirectly to earning of income by non-resident. in his business, a course of dealing and continuity of relationship, and not merely isolated or stray nexus. So it has to be a continuous nexus, I would say. Business connection includes the activity carried out through a person who habitually exercises in India authority to conclude contract on behalf of non-resident, or habitually plays a principal role leading to conclusion of contracts by that non-resident, and the contracts are in the name of non-resident, or transfers of ownership or of granting the right to use the property owned by that non-resident for the provision of the services of non-resident, maintains in India stock of goods, secures orders in India mainly or only for non-resident. So just to summarize this particular slide, effectively, if a non-resident is dealing through an agent in India, and that agent is dependent on that particular non-resident for his own business, right? And that agent in India exercises the authority to conclude the contract. So for example, if I am an agent for a non-resident company or a foreign company, and I have the right or authority to conclude the contract on behalf of that non-resident, then I become his business connection in India, right? Then that foreign company has a business connection in India, and therefore the provisions of 911 will get triggered. The other option or other, I would say, category is I maintain the stock. That is, I physically maintain the stock on behalf of the non-resident. Now here again, what is important is initially to overcome this, what people used to do is everything, negotiation, etc. used to be done by me. It is just that the signing of contract was done by the non-resident and the Indian customer. So I used to argue that I am not signing the contract, right? But I am playing a principal role in negotiating and finalizing this contract. So this amendment which is being brought in, which is in red, I have played a principal role leading to the conclusion of contracts by that non-resident. That also will be covered in the definition of business connection. Now this amendment is being brought in pursuant to the global development of BEPS and MLI, right, which will briefly capture in the subsequent slide. It's a different topic altogether, but this misuse which was being done globally, that I negotiate the contract, I do everything, but the signing will be done by the non-resident and the customer directly. So people used to argue that I am not signing the contract, I don't have authority to sign the contract, so therefore I am not an agent, or the agency fee or business connection does not trigger. So therefore they have brought in this amendment. This amendment has also been brought in the definition of permanent establishment when we talk about the dependent agency, or maintains stock, or even secures orders. So if I secure the order mainly or only for that particular company or group, then effectively, even in that case, the business connection gets triggered. So initially there was an exclusion that if my role was limited to purchase of goods for the non-resident, which was again to be sold to a non-resident, that is, I just used to act as a purchaser. I purchase the goods on behalf of non-resident and again sell it to the non-resident. There was an exclusion that this will not result into a business connection. That also has been deleted now. So even if I am purchasing the goods, I am merely purchasing the goods on behalf of non-resident, the business connection gets triggered. Business connection does not include any business activity carried out by a person having an independent status acting in the ordinary course of business. So as I said, that I have to be a dependent agent. I have to be a dependent agent. Now this is similar to the dependent agency P in the treaties, which we'll cover briefly subsequently. So therefore, if I am acting as an agent for 10 non-residents, 10 different non-residents, right? So therefore I become an independent agent. I am not a dependent agent. So this business connection gets triggered only if I am a dependent agent. So attributes and exceptions of business connection. In case of business for which all operations are not carried out in India, income reasonably attributable to the operations carried out in India shall be chargeable to tax in India. So effectively, once you have a business connection, we move on to the next step, that is attribution. How much of the income is taxable in India? right? Not the entire income will be taxable in India, but the income which is attributable to the activities in India. Now, this in itself is a very subjective term, because according to the taxpayer, the attribution should be minimal, but according to the tax officer, the attribution should be maximum, because they will say that the entire income is earned from India, so therefore 100% should be chargeable to tax. So this is where the litigation will end up. Exception: no income shall be deemed to accrue or arise in India. In case of non-resident, the business, again, this was there earlier, but this has been deleted now. Non-resident running a news agency or publishing newspaper activities are confined to collection of news and views in India. So this is for media sector. Individual firm or company whose operations are confined to shooting a cinematographic film. Foreign company engaged in mining activities are confined to display of uncut and unassorted diamonds in any SEZ. So these are few exceptions. But generally, if you look at the concept of business connection, it is similar to the dependent agency P. So case study, if we look at it by way of example, so we have a Supreme Court ruling, which is a landmark ruling in the case of R.D. Agarwal, which has laid down the principles of what do you mean by business connection and various interpretations thereof. So let us look at this by way of a case study. Mr. X, an assessee, carried on a business as an importer, as a commission agent of non-resident exporters. For two of the non-resident exporters, he canvassed the orders for supply of woolen yarn and communicated the same to the non-residents and received the commission on the sale made by them. Mr. X had no authority to accept any order on behalf of non-resident. Non-resident was not obliged to accept the orders procured by Mr. X. The orders were accepted, price received, and delivery of goods was given by the non-resident outside India. So now in this case, I don't have authority to conclude contract, right? So will business connection trigger in this particular case? No. Clear? But again, let us look at the amendment. If I have played a principal role here, right? I have no authority to conclude contract. I have not signed any contract. But if I play a principal role here in negotiating this contract, right? Here, of course, if you see, non-resident was not obliged to accept the orders. This arguably can say that I don't have that much of power or authority even to negotiate beyond a point. So if I play a principal role in negotiation also, post this amendment, the chances are high that I may be considered to have a business connection in India. So therefore, it is very fact specific, and you need to look at each case by case and also look at the documentation, the agreements, etc., to arrive at a conclusion whether business connection exists or not. Case study 2. ABC of Netherlands used to import iron and manganese ore from India. Being dissatisfied with the activities in the Indian exporters from whom it made purchase, it appoints Mr. A as its representative in India. Mr. A was to supervise the correct execution of the contracts by ABC with the Indian exporters as to quantity, quality, time of delivery, etc. A's activity involved procurement of raw material, that is getting the stock, and ensuring regular and proper supply of raw materials. A used to get remunerated from ABC. Now here, clearly, I am taking the delivery of the stock, the raw material, etc. on behalf of non-resident. So effectively, there is a business connection. Now, this is that amendment which I told about the Vodafone case, the substantial value in India. So let us look at that case study. The same example, two shareholders, one is the buyer, one is the seller, both are outside India. The company, the SPV of which the shares are being sold, also is outside India. It has an ICO, that is the investment in Indian company called ICO. SPV shares deemed to be situated in India if the value of ICO is more than 10 crores. Value of ICO is more than 10 crores. And the value of shares in the Indian company is more than 50% of the value of assets of SPV on the specified date. Specified date means the balance sheet immediately prior to the date of transfer. Date of transfer, if book value on the date of transfer is more than the book value on the balance sheet, then obviously now what I need to understand here is 50% of the value of the total balance sheet of SPV. That has to be in India. And of course, the value of ICO should be more than 10 crores. Both these conditions have to be satisfied to trigger indirect transfer. Otherwise, indirect transfer will not trigger. Okay, so moving on. Yeah. Multiple layers of subsidiaries. So effectively, you need to look at, for example, if you look at illustration 3, transfer the shares of SPV1. Below SPV1, we have SPV2, step down subsidiary. And below SPV2, we have ICO, right? So what we need to see is ultimately, assuming SPV1 holds 100% in SPV2, right? And SPV2 holds, say again, 100% in ICO. Ultimately, if you look at it, the calculated number, it still has the value in India, right? Even if it is a step down, but the value is still arrived at from the assets in India. Okay, so let us look at this. Here, being any shares or interest in foreign company shall be deemed to be subsidiated in India if such shares or interest derives directly or indirectly, right? So what this illustration 3 is indirectly. Indirectly, I am holding in India. So therefore, you need to look at what is the consolidated number which I am holding in India. Even if it is a step down subsidiary, does not matter, right? You have to dwell down that ultimately what is the percentage which I am holding in India. See, these are concepts on which we can go on for hours together, but here the idea is not to go deep, but just to give a flavor and come to the specific aspects of what is relevant. Then coming to the treaty benefits, as I said, as far as a non-resident is concerned, he is eligible to treaty benefits. So act or treaty, whichever is more beneficial, he can be governed by that. He can choose to be governed by that, right? So section 90 specifically covers the treaty aspects. And now, as I said, with the recent development, the treaty has to be read with the MLI amendments. And we will briefly cover what MLI is all about and how the treaties are being impacted post this MLI amendments. So what is relevant is for claiming the treaty benefit, you should be a non-resident in India and resident of a particular country of which you are claiming the treaty benefit. For example, if I am a resident of UK and a non-resident in India, I can claim the treaty benefit of India UK, provided I have to prove that I am a resident of UK. How do I prove that? I can prove that by getting a tax residency certificate from the UK government, that is the home country. I have to provide the TRC, that is tax residency certificate, right? And along with the TRC, I also need to give certain information because the TRCs of all the countries are different. They have their own formats, they have their own information which is being provided, but India may need some additional information. So therefore, what they are saying is if the details which we need is not covered in the TRC, you need to provide form 10F, which gives you all the information, that is status of the non-resident, that is individual, company, firm, PAN of non-resident, nationality, TIN number, that is tax identification number, period of validity of TRC, address of the non-resident, etc. Non-resident necessity to keep and maintain documents which are necessary to substantiate the above information. The Indian tax authorities may demand the same at a later stage, right? So this is the proof for you to prove yourself to be a non-resident and claim a treaty benefit of a particular country. Now, why TRC is important is subsequently we'll see 206AA, where if I am a non-resident and I don't have a PAN in India, right? So basically, just to give you a background, 206AA says that if there is no PAN in India, then the taxes to be deducted at the highest rate, that is 20%, or the rate in force, whichever is higher. But for non-residents, there is a relaxation that 206AA will not apply, provided you submit your TRC. So therefore, TRC will play an important role even in 206AA. Now coming to the taxability of certain aspects, certain income in case of NRIs, non-resident, taxability of capital gains. Now quickly, as far as capital gains is concerned, the period of holding, that is short-term, long-term, plays an important role. So just for the sake of completeness, I have included this slide, that is the number of months for each category of asset, how will you determine whether it is a long-term or a short-term. So for example, listed securities 12 months, unlisted securities 24 months, equity mutual fund 12 months, debt mutual fund 36 months, zero coupon bond 12 months, bonds 36 months, unlisted debentures and 36 months, again units of UTI 12 months, and land building immovable property 24 months. So general category is you either may come across land building property or shares. Listed 12 months, unlisted 24 months, land building immovable property again 24 months. So if it is more than 24 months, effectively it becomes a long term. Less than that, it will be a short term. So taxability of capital gains, equity shares, units of equity oriented mutual fund, UTIs, etc. Earlier there was an exemption for the long term capital gains. Now it is taxable. Listed securities 10% without indexation, no indexation benefit. Unlisted securities also again for closely held companies, 10% indexation not available, and foreign currency benefit also not available. Short term, again, if I talk about individual listed, it will be taxed at 15% for non-STT, etc. For individuals, basically, it will be as per the normal slab rates, right? Sorry. Bonds, debentures, government securities, units of other equity oriented, other than equity oriented mutual fund. Again, unlisted and listed both 10%, indexation benefit not available, and currency benefit also not available for the unlisted securities. Short term, in case of individual, STCG taxable at the normal slab rate as may be applicable. Other assets, residential house, for example, a very common situation where a flat is sold by an NRI, etc. The long-term capital, long-term rate is 20%. Again, indexation benefit will be available. STCG again will be normal rate as far as the individuals are concerned. Surcharge is applicable, yes. So if you see the asterisk, tax and rates are exclusive of surcharge and education cess. So surcharge and cess is applicable.
In case of inherited,
Yeah. Yeah. So as far as a gifted property or inherited property, as far as NRI is concerned, the period of holding effectively the of the previous owner will be considered, right? Yeah. Yeah. So taxability of capital gains, shares or debentures, currency fluctuation. So now specifically what happens is where the shares or securities are purchased in foreign currency, right? Then in that case, you don't get the indexation benefit, but you are eligible to claim the first proviso, that is the currency fluctuation. So how the calculation is done in that case is the cost of acquisition, expenditure on transfer, and full value of consideration to be considered or to be converted in foreign currency in which the shares or debentures were acquired. So you convert it in the foreign currency. Capital gain shall be reconverted to Indian currency, right? The capital gain will again be reconverted to foreign currency. The conversion rate for calculation of capital gain shall be average of TT buying rate plus TT selling rate, that is the SBI TT buying rate and SBI TT selling rate ka average as per rule 115A. Cost of acquisition, date of acquisition, जिस डेट का एक्विजिशन है उस डेट पे आप उसको रिट्रांसफर रिकैलकुलेट करोगे. एक्सपेंडिचर ऑन द डेट ऑफ ट्रांसफर, Full value of consideration again on the date of transfer. So this is how you reconvert it in the foreign currency and then again recompute the foreign exchange assets capital gains accordingly. Moving on to taxability of royalty and FTS. As I said, these are the more common payouts from Indian payers are considered as specifically for issuance of 15 CACV, etc. So taxability of royalty. Definition under the Act: consideration including lump sum consideration for transfer of all or any rights, including license, in patent, invention, model, design, secret formula, or IP, that is intellectual properties. Copyright, literary, artistic, or scientific work, including films, videotapes, tapes for using in India, TV broadcasting, etc. Or imparting of any information concerning the working of or the use of the IP, which is in the first basket. Technical, industrial, commercial, scientific knowledge, experience, or skill. Last, use of any IP or right to use any industrial or commercial or scientific equipment. So equipment is also covered here, equipment royalty. So if you look at it, it also covers rendering of any service in connection with the above. So the royalties which are taxable in India is effectively dealing with IPs, that is technical know-how, trademarks, knowledge, etc., or even the information in relation to the same. Technical, industrial, commercial, scientific knowledge, experience, or skill, etc. So effectively, if I am having any know-how, patent, trademark, copyrights, for which I am making a payment to a non-resident, all those payments will be covered in 916 as royalties. Now, if you look at this definition, it is very, very wide and it covers everything. It also covers computer software, because ultimately that also is an IP and I have the right to use that software. So therefore, that also is covered in the definition of royalty on an overall basis. But of course, as I said, for non-residents, you have the treaty protection also. Now, there has been few amendments by Finance Act 2012 because of certain favorable rulings, and the CBDT as usual has brought in retrospective amendments from 1st June 1976. Explanation 4 says use or right to use the computer software, right? Because there were judgments on software royalty where the courts had held that that is not taxable. So therefore, to overrule those judgments, they brought in this explanation retrospectively that use or right to use of computer software, including the granting of license, was always deemed to be royalty. Explanation 5, test of possession, control, use, location of right to property or information not relevant. Process includes or right to use transmission by satellite, including uplinking, amplification, conversion for downlinking any signal, cable, optic fiber, etc. Now, this is specifically where the arguments were taken that the server is not in India or the transmitter is not in India, right? So effectively, I don't have access or control over that equipment. So therefore, the court held that yes, you don't have the control, you don't have the physical use of that particular asset, or you even don't have the possession of that asset. So therefore, this is not in India, therefore not taxable. But to overrule all these judgments, the retrospective amendment was being brought in by the finance minister in Finance Act 2012. They're saying nothing doing. Does not matter transponder kidhar hai, does not matter transmitter kidhar hai. If you are uplinking or downlinking your data from India, it means you have the right to use and therefore it is subject to royalty. However, this is again Act. We have the treaty protection, which will come to in the subsequent slides. So this is what we come to the treaty. Now we don't have time to go to the specifics of the treaty, so we'll just go by the model-wise treaties, that is OECD model and the UN model. Payment of any kind received as consideration for use or right to use. Copyright of literary, artistic, or scientific work, including cinematographic film, patent, trademark, design,
or model, plan, secret formula or process. Information concerning industrial, commercial or scientific experience. This is the narrowed definition as far as the treaty, OECD treaties are concerned. UN treaties, if you see, generally India follows UN model. Generally, few exceptions here and there, but generally we follow UN model. Use or right to use of copyright, literary, artistic, scientific work, including cinematographic films or tapes used for radio, television broadcasting. Patent, trademark, design, model, plan, secret formula or process. Industrial, commercial or scientific equipment. Information concerning industrial, commercial or scientific experience. So again, this is a narrowed down definition. If you look at these exclusions or these explanations which expand, for example, computer software, right? Use or right to use of computer software. Here, use or right to use computer software is specifically not coming. And specifically, recently, if you are aware, the Supreme Court has ruled in favor of the assessee, specifically for the Shrinkcraft software, etc., that these softwares, the transfer of these softwares are not taxable in India under the treaty. So therefore, no withholding is required, right? So this becomes more relevant. The reason why I'm discussing is that the treaty plays an important role for taxability of royalty. Now, whenever we talk about royalty or FTS, it is important for us to understand, obviously, generally, the treaty will be beneficial. But as a principle, what is relevant is that the common mistake which people make is we directly jump onto the treaty for arriving at the tax rate or arriving at the taxability. As a thumb rule or as a general principle, it is always important for us to analyze the taxability under the Act first and then move on to the treaty, because at times it may be possible that Act may be, at times, may be favorable. For example, if I look at the India-UK treaty, the tax rate of FTS is a 15%. India-Singapore 15%, India-US 15%. But the rate in Act is 10%, right? So Act is more beneficial. So it is important for us not to directly jump onto a treaty, understand the implications under the Act first, then move on to the treaty. First of all, you also have to check before applying the treaty that whether treaty is applicable to that person or not, whether that person falls in the definition of the person who is eligible to, the eligibility to claim the treaty is also important. So the first Article 1 to Article 4 also play a very, very important role to understand the coverage of the taxpayer within the ambit of the eligibility to claim the treaty. So taxability under the Act, as I said, Section 916 is the deeming fiction received in India. Obviously, it will be taxable in India under Section 5. So the tax rate is given under Section 115A. It will be taxable at the rate of 10% plus, of course, applicable surcharge and cess. If there is a permanent establishment, then it will be taxable on net basis subject to the conditions and criteria in accordance with Section 44DA. So a snapshot, royalty paid by Indian concern or Indian government, and if it is a right, property or contract effectively connected with the PE. If the answer is yes, if it is connected to the PE, then the tax will be at the rate of 40% and not 10%. But if there is no PE in India, then the taxability will be under Section 150 rate of 10%, provided the agreement is approved by central government or included in industrial policy. Now, this is particularly a gray area, and the question being asked always, how do I find out whether my agreement is approved by central government? Now, in the earlier regime, the FERA regime, etc., where the global trades were restricted, the agreements used to be approved by the central government. Now, there is no such approval required. The agreements are auto-approved. As such, no approval required. And industrial policy also is as such very wide, so therefore you will not be able to find whether this falls in the industrial policy or not. Generally, the position which we take is that, considering that the free trade and all, and the industries in which we are dealing with generally are not restricted and it is covered by the industrial policy. But if you go deep and if someone challenges that, how do I find out whether this is approved by government? The answer is no. Whether it is covered in the industrial policy, again, will be a tricky thing. How do I understand whether it is covered by the industrial policy? As on a practical aspect, we always assume that it is because there is no restriction by the government. So therefore, it is as per the industrial policy. Because the implication is if it is not approved by central government or not as per the industrial policy, then the tax rate increases to 40%. So treaty, a snapshot, Article 12 deals with the taxability of royalty, distribution of rights of contracting states, that is which country will have the right to tax. Generally, the source country is the country which has the right to tax, obviously, because if I am a resident, generally the global income is chargeable to tax. So 12.1 gives the right to the source country also to charge the tax. 12.2 gives the ceiling on the gross taxation, that is the tax rate at 10%, 15% as per the respective treaties. 12.3 gives you the definition of royalty, which we just discussed in the earlier slide, UN model, OECD model. 12.4 taxation of royalty if it is effectively connected with the PE. 12.5 arising of royalty in the state of source where payer is resident or if the payer has a PE. So again, if it is arising in the state of the source where the payer is resident or if the payer has a PE and if it is borne by that particular PE, effectively it is connected to the PE. So therefore, this is the provision which gives the right to tax in case of a PE situation also. 12.6 adjustment for related party transactions. So effectively, if the transaction between two related parties are not at arm's length, then the difference will be chargeable to tax as per the domestic tax law. Then coming to FTS, that is fees for technical services. Again, definition as per Act 917. Consideration for rendering managerial, technical or consultancy services, including provisions of services of technical or other personnel, but does not include consideration for construction, assembly and mining or like project or income by way of salary, because salary is charged as income under that income from salary. So if you look at the definition of FTS, it includes managerial, technical or consultancy services, okay, under the Act. If you look at the treaty, generally the definition is more or less the same. However, some countries don't have managerial, but the important concept under the treaty is the concept of make available. There are various treaties which narrow down the definition of FTS to restrict it only in case where it makes available. Now, what do you mean by the concept of make available? We'll come to it in the subsequent slide. Technical knowledge, experience, skill, know-how or process, or development and transfer of technical plan or design. Under OECD model, if you look at the original OECD model, there was no clause on FTS. And it was to be taxed as business income earlier. So generally, if you don't have an FTS clause, for example, India-Thailand treaty does not have an FTS clause, then what do? Treaty is still applicable. And you need to look at Article 5, that is the PE. If you don't have a PE, then as per Article 7 and Article 5 read together, it will be taxed only in the resident country and not in the source country. So for example, if I am making a payment of managerial remuneration or management fees to a company in Thailand, and the does not have a permanent establishment in India, then as per India-Thailand treaty, this FTS is not taxable in India because I don't have a PE in India and there is no FTS clause in the India-Thailand treaty. So as I said, treaties with US, UK, Singapore, Australia, Canada have the concept of make available in the FTS definition. Make available, what do you mean by make available? Mere requirement of technical input by a person providing services does not necessarily mean technical knowledge is made available. Use of product which embodies the technology cannot be considered to make technology available, because nowadays all the services are provided by way of technology. For example, if the service is providing by email, right? I am rendering services by email, obviously, which is use of technology. So does it mean that technology is made available? The answer is no. Of technical knowledge, skills, etc. from person rendering services to person utilizing the services. Technical knowledge, skill, etc. must remain with the person utilizing the services even after rendering the services has come to an end. So effectively, the technical knowledge, skill, etc. must remain with the service recipient in such a way that he is able to make the use of the technical knowledge independently without recourse to performer of the services in the future. For example, I am obtaining services of an IT consultant for designing a software or for designing a particular application, right? And that person renders those services. He also gives me the source code. He also gives me the source code so that later on, if I want to make any amendment, etc., I can do it on my own. Now, this is known as make available. And actually, you are giving me the technical expertise, technical knowledge, etc., so that later on, if I want to do something in this particular thing, I can do it on my own, and I don't need to come to you again. This is when we call that make available gets triggered. So therefore, it narrows down the definition very significantly as compared to any particular, because if you look at the act, rendering of managerial, technical or consultancy service, it is very simple that almost all the services will be covered in the definition of FTS. So therefore, in these particular countries where you have make available, plus in the other countries also where you don't have specific make available clause, but you have a most favored nation clause, which will come to in the subsequent slides. Even in those cases, for example, France, Netherlands, etc., you can take recourse to the make available clause and thereby reduce the scope of taxability or reduce the scope of definition or even rate in certain cases for taxability of fees for technical services. So therefore, the concept of make available becomes very, very important. So again, 12.1, the snapshot of treaties, distribution of rights similar to royalty, which country has the right, source country gets the right by way of 12.1. 12.2, ceiling of gross taxation, that is 10%, 15%, etc. 12.3 gives you the meaning of FTS. 12.4, FTS, taxability of FTS if effectively connected to the PE. Similarly, 12.4 and 12.5 for royalty and FTS are similar. 12.6, adjustments for related party transactions. Again, that is what we discussed in royalty also. If it is not an arm's length, the difference will be charged to tax as per the domestic tax rate or the domestic tax law rather. Then moving on to the dividend, interest, the other aspects of taxability. Now, sorry, interest income generally is taxable at the rate of 10%, 20%. Again, subject to the treaty benefits. As far as dividend is concerned, earlier dividend was exempt because dividend distribution tax was there. But now the DDT is no longer applicable. So the dividend is taxable in the hands of the shareholders. So if you have a non-resident shareholder being an NRI or foreign company, whatever, the dividend will be taxable at the rate of 20%. Again, this will be subject to surcharge cess. Interest on infrastructure bond is taxable at 5%. Interest on rupee denominated bond, these two are at a concessional rate of 5%. Interest on loan raised in foreign currency, 20%. Royalty and FTS, we just saw 115A, 10%. So this is a snapshot of special provisions for non-resident on taxability. Now again, for dividend, you have the treaty protection or treaty benefit for a lower rate of 20%, a lower rate of 10% and 5% also in some countries. So this, the treaty. Yeah, so I'll come to that. So for example, you are a non-resident and you are a resident of a particular country, say US, UK, whatever, right? First of all, you need to have a TRC in place. and you need to provide Form 10F, and of course, a no P, you should not have a permanent establishment in India. So if you satisfy these conditions, then you have to give these documents to the payer that this is my TRC, I am eligible to claim the treaty benefit, and this is my Form 10F, etc. And I don't have a P in India, so therefore I am applicable or I am eligible to claim the treaty benefit of lower tax rate of 10% or the narrower definition of make available clause, etc. So therefore you deduct the tax accordingly, considering the treaty benefits.
Practically, what happens is those NRIs have lots of shares in the demat.
Yeah.
Basically, they rather than giving certificates and all these to all the companies.
Yeah, so that is the safest approach from a deductor's perspective, that you deduct at a higher rate and let the person claim the refund. That is a simpler approach from a deductor's perspective. But generally, what happens is, they insist that you deduct at a treaty rate. Now, it is for the deductor to take a call whether the treaty is applicable, not applicable, because the risk is on the deductor. If you look at it from the deductor's perspective, if I give him the treaty benefit, relying on the TRC, etc., ultimately, if the tax authorities say no, he was not eligible, you have to deduct at 20%. The entire liability of 201 interest, etc., the prosecution comes on you. So as far as the deductor is concerned, we always advise the deductors to go conservative. But practically, it is not possible for the deductors to go conservative because samne wala manega nahi. He will come back on me that now dividend is a simple case, but if you are having FTA scenario or royalty scenario, he will say, I have n number of clients in India, nobody is deducting, why are you deducting at 20%, etc. So, and the business relation gets impacted. And generally what is happening is the dealing is with the business guy and not with the tax guy, right? So therefore he will say, yaar kaatna 10% chhodna yaar, mere ko magazmari nahi hai. So practically this is what happens. But yes, you are right. We always suggest to go conservative, but practically very few people go conservative. Yes, sir.
The question is, person who is filing the return, what is the procedure that he can apply 20% and not the slab rate of 30% if he is coming in IS?
Yeah. So I am talking from the perspective of the taxpayer now, the recipient of income. Again, the same procedure. I need to have TRC, 10F, etc. in place. That is not to be submitted in the return of income. I just claim the treaty benefit that I am a non-resident, and there is a schedule SI in the return of income wherein I am eligible to claim the treaty benefit and take the reduced rate of 10%. That's all. If at all my case is picked up for scrutiny, etc., at that point in time during the assessment proceedings, I need to give all these documents of TRC, 10F, etc.
And still you can take the benefit of the slab and all for a file. Suppose my dividend income is
Yeah.
like, okay, so basically still lower,
Yeah.
or I have to go for minimum 20%.
No, so I am eligible to claim that slab rates. That is okay. Yeah.
By filing the return of an NRI,
Under section 115.
So under section 115A, so for dividend taxability, you have a special tax rate of 20%. Dividend is taxable at 20% as far as the act is concerned. But the question is whether I am eligible to the basic exemption limit. The answer is yes, I am eligible for basic exemption. 20%. And not as per the slab rate. Yeah, I'll come to that. I'll cover that towards the end. Yes. If any. So if PAN is not there, then the TRC will suffice. So I'll cover those aspects towards the end on the PAN number and the 206AA, etc.
Carrying on the cost, of that.
Yeah.
So like say CRM software, bill is paid associate of the MNC.
Correct.
Now the part of the cost is
Allocated.
allocated to India, and then
Correct.
Indian company has to remit to this
Yeah.
one.
So in this particular case, there are two ways to look at it. Technically, this is CRM is basically a royalty because it is a software. So ultimately, it is a royalty. So first of all, you need to check whether it falls in the definition of royalty under the treaty. Now the question, the real question here is, can I treat this as a reimbursement? Because the group always says that this is a cost to cost allocation and it is allocated either on the basis of number of employees, number of headcounts, etc., etc. But the real question here is the documentation. How do you prove this is reimbursement? Because there will be a single bill which is being charged to the group company which is making the payment to the vendor, right? So that single bill is being bifurcated to different countries based on my cost allocation, right? The real challenge is, how do I prove as a back-to-back arrangement that this is a pure reimbursement? As a principle, if you ask me, if there is any reimbursement, there is no taxation. But the real challenge is, how do I prove this is a reimbursement? So a practical aspect here is that it is, and my practical experience says you will never get the backup. Because
They said it is an internal document.
it is an internal document, they will not give it. Even the Indian, forget tax officers, even the Indian tax guys, if you ask from their counterpart, you will say, yeah, you will not get the document. Company ko bhi nahi milega. Tax department ko jaane do. So practically speaking, in such cases, as I always say, as deductor, you have to be conservative. Plus the other aspect is whether this is genuinely a reimbursement, because the department has been taking a view that this is reimbursement chhod do. This is a technical service or royalty which is being rendered. Just because you are interposing it through your group company does not mean it is not a royalty or FTS. You cannot term it by way of reimbursement. That is another argument which department is taking. You can apply 44C for branch cases, not for group companies. 44C is for branch, right? So the question here is, practically it will be very difficult. You deduct the tax at source, let the foreign company claim it as reimbursement, not taxable, let them fight. Obviously fight humko hi karna hai because India mein unka koi hai nahi. But we should not take that hit on our head as deductor, because 201, 48 disallowances, etc. is much more as compared to the taxability in the hands of the foreign company. Because practically, if you look at it, if they are getting credit in the home country, why to get into those litigations? Yeah.
In connection with installation of machinery, various services,
Correct.
whether any withholding tax.
See, if it is an independent service, even if it is in relation to that machinery, right? If it is charged separately, then arguably it is FTS. While you may argue that this is installation cost, etc., and it has to be built in the cost of the machinery. But if the bill is raised separately as technical services, then arguably it is technical services. Yeah, then it is a good case. But practically speaking, I have not seen a single case where you have one-to-one matching of reimbursement. Very rare. Loss, as I said, this has caught fire very recently after the taxability of dividend being coming into picture. Why I am saying is, there are few countries which have the taxability of dividend of 5% as compared to the 20% in the Act. And therefore, all of a sudden, this clause has gained a lot of importance, specifically Netherlands, France, the European countries. What do you mean by MFN? Normally, benefit under this clause is restricted to a specific group like OECD countries, because generally it is given to the member of OECD countries. Benefit is provided normally with respect to the rate of tax, liability to tax, deduction permissible, attempts to avoid discrimination between residents of different countries. MFN clause usually found in protocols and exchange of notes, ensures equal treatment between a subset of countries, extends similar benefit to one country as. So let me give you an example of MFN clause. What happens is, generally the European countries, right, they operate in a EU situation, EU scenario, right, where they have common regulations, etc. So if India is entering into a treaty, say with France, and they agree that tax rate is 10%, right? Later on, subsequently, India enters into a treaty with, say, Sweden after France and says that the tax rate is 5%. Then France will say, boss, we both are neighbors, right? I will lose my business just because you are giving them 5%. Now people will prefer taking services or whatever from Sweden and not for France. So therefore, there is this MFN clause that if at a later date, after entering into an agreement with me, for example, France, you as India enter into an agreement with any other country which is member of OECD, and you give them a lower rate, 10% or 5%, or restricted definition, right? Liability to tax, restricted definition. For example, वहां पे make available है, France में make available clause नहीं है. If you look at the France treaty, there is no make available clause, but there is a make available clause in other treaties where you can claim MFN benefit. For example, Portugal, which is entered after France. For example, Sweden again, which is entered after France. So there they are saying कि अगर आज के बाद आपने किसी और कंट्री के साथ ऐसा एग्रीमेंट एंटर किया जहां पे आप उनको बेनिफिट दे रहे हो लोअर रेट का या रिस्ट्रिक्टेड डेफिनेशन का, तो वो बेनिफिट ऑटोमेटिकली मुझे भी अप्लाई होना चाहिए ऑटोमेटिकली. आई नीड नॉट रीनेगोशिएट द ट्रीटी अगेन, बिकॉज treaty negotiation is a very difficult and a long born process, right? It may take years together to conclude the treaty and to notify the treaty. So therefore this is like a bearer check कि आगे चल के अगर आप कुछ ऐसा करोगे, it is a part of the notification which on which the treaty is signed as by way of a protocol. Protocol is a part of the treaty, a lower part of the treaty. ट्रीटी में क्या होता है, पहले आर्टिकल्स होता है 1 2 3 4 25 आर्टिकल्स, एंड देन यू हैव द प्रोटोकॉल्स और एक्सचेंज ऑफ नोट्स. सो दिस फॉर्म्स पार्ट ऑफ अ प्रोटोकॉल, राइट? सो इफ यू लुक एट दिस एग्जांपल, नीदरलैंड्स, इंडिया हैज एंटर्ड इनटू अ ट्रीटी विद नीदरलैंड्स और इन 1991, राइट? स्वीडन के साथ ट्रीटी कभी एंटर किया 99 2000, एंड स्वीडन हैज द MFN, नीदरलैंड हैज द MFN clause, and the lower rate of tax is applicable in the Sweden treaty. So automatically I can take the benefit of MFN clause in the Netherlands treaty and claim that the tax rate which is in Sweden will automatically apply to Netherlands treaty, right? Now, is it simple? It is simple for us. Yeah, TRC and all that will be required. That is always there, right? Practically, from our side, this is simple. But if you look at it from the tax department side, they have a different angle to it. What they are saying is, no, your MFN clause is not notified. Government has to notify it separately. Okay? The argument which department is saying is, ये जो आपका MFN clause है, उसको notify करो. मतलब 99-2000 में आपने स्वीडन के साथ ट्रीटी एंटर किया, उसके बाद में वापस नोटिफाई करो कि ये जो स्वीडन का रेट है वो एप्लीकेबल होगा. जब तक आप उसको स्पेसिफिकली नोटिफाई नहीं करोगे, आपको MFN का बेनिफिट नहीं मिलेगा. Now, when I have signed an agreement and notified that which has the protocol already in it, why do I need to enter into a separate or issue a separate notification, right? Then what is the use of that protocol and signing it way before? That is the argument on behalf of the association, which is fairly accepted by the courts. And let me tell you why I am saying this is relevant today. Dividend, as I said, 3 countries have dividend rate of 5%. So therefore, all these European countries, Netherlands, France, Switzerland, have now the benefit to claim this 5%. And in fact, there are companies which have already claimed 5%. Delhi High Court, couple of cases have issued, 3 cases in fact, Nestle, I don't remember the name, C naam hai, where 3 cases where they have actually given a favorable ruling that MFN clause is not to be notified separately. After this Delhi High Court ruling, department came up with a circular, again reiterating the same thing which I said. Delhi High Court ko negate karne ke liye they brought in a circular saying no, notification has to be done separately, etc., 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 and the Delhi High Court ruling is not applicable. Even after this MFN clause, or even after this circular, one of my matters was pending before the Pune tribunal, and I have got a favorable ruling even after this circular, that this circular is not, first of all, obviously we argue that circular is binding on department and not on the taxpayers and not neither on the courts. But even on merits, what is relevant is the protocol is already part of the treaty, it did not be notified separately, which is the argument. Of course, there were other arguments also, but this is a moot argument in the interest of the time, which I thought I'll cover. Concept of PE, again, this in itself is a topic which can take the entire day, but PE is basically a permanent establishment. Now, basically, again, as I said, I can go on for hours together, but I don't have time to go deep into the PE aspects because this topic is very close to my heart, and in fact, I am doing PhD on this very topic of permanent establishment. Very much disputable. So, in fact, I'll give you a live case. I had applied for lower withholding at 5%, relying on these Delhi High Court rulings. The department denied, saying that their judgment is pending before Supreme Court. So therefore, we cannot give you 5%. I have filed a writ petition before the Bombay High Court, and the hearing is, ideally it was for tomorrow, but it is not coming up on board, but it will be coming up somewhere in July. So we also have filed a writ petition before Bombay High Court on this very same issue, because the department is not allowing 5%. Netherlands, Switzerland, France. There are a few more, but these 3 are the prime with which India deals.
5%.
Yeah.
If a person is an NRI, but the income, the bonds are from his mother, who was an Indian resident. So, and now it is taxable in his hands.
See, arguably, you need to look at the nature of the bond, right? And not the, if you look at this, infrastructure bond. The bond is to be issued to a non-resident, is what I believe. I need to check. I'm not sure on this. I'll just double check on this and come back to you. Chirag bhai, any views?
Yeah, it is you have to see section 194C, LC and LD.
Yeah, LC and LD.
LC and LD.
Yeah. If you qualify the conditions of LC and LD, you are eligible. You need to look at the bonds to which, to whom it is issued. Yeah. So I'll just quickly cover the types of PEs in a brief, and then we move forward quickly. Fixed place PE is basically when you have a physical presence, physical office in India. Agency PE is similar to the business connection which we discussed, that is dependent agent. Installation PE is basically a construction PE where you have a construction site, etc. in India. And the number of days generally is more than 6 months, 180 days or more in most of the treaties. Service PE is a PE where employees of foreign company come to India for rendering services, and their stay in India goes beyond particular number of days. Different treaties have different days. Some treaties have 30 days, some treaties have 1 day for associated enterprises, some treaties have 182 days, etc. So this is the concept of PE in brief. Now we come to the last or the important part of foreign remittances, that is 195, TDS, etc. because that is more, I thought that will be more relevant from the deductor's perspective and also from the practicing chartered accountants for issuing 15 CACB. So overview of section 195, 195.1 scope, conditions, 195.2, that is the lower withholding by payer, 195.3 lower withholding by payee, 195.4 says the validity of certificate. 195.5 powers of security. 195.6 furnishing of information relating to payments. 195.7 deals with the authority to specify cases who can make application under 195.2, and 195A is grossing up. So quickly, 195 says tax withholding on making the payment to a non-resident. When the tax is to be withheld, what is relevant is that the sum has to be chargeable to tax in India. I'll not go into the reading of the section, etc., in the interest of the time. But what is relevant is the income has to be chargeable to tax in India. If that income is not chargeable to tax in India, then there is no withholding. Who is responsible? Any person, including individual, HUF, partnership firm, companies, whether resident or non-resident. Payment to a non-resident foreign company does not include RNOR. It does not include RNOR. So RNOR will be covered in the domestic provisions and not in 195. Nature of payment, again, interest, salary, etc. Salary and exempted dividend is excluded, but now there is no exempted dividend. Dividend is taxable. Who to deduct? Again, when to deduct? At a time of credit or payment, whichever is earlier. That is very normal and clear. However, exception is when it is made to the it is paid to government, public sector banks, etc. Then it is to be on payment basis. If you look at the treaty, now it is interesting that Act says paid or credited whichever is earlier, payment or credit whichever is earlier. If you look at the treaty, Article 12 for royalty FTS typically uses the word paid. Typically uses the word paid. So here, can you argue that tax is to be deducted only when it is paid? Arguably, yes. We have various judgments, including Mumbai Tribunal, Bombay High Court, wherein they have said that unless it is paid, tax is not to be withheld. But with a word of caution, there are judgments to support your view. If you have not deducted, you can take support to these decisions. But if you are at a planning stage, we would still advise deduct and go ahead, because assessing officer is not going to accept it. You will have to fight it. CIT appeal may or may not give you the relief. Again, in the faceless regime, we don't know. You have to go to the tribunal and relief up to Milega tribunal may. So if you have that appetite to go up to the tribunal high court, you can very well take resort to this judgment and say that I have not made the payment, I have just made the provision, therefore no TDS, but it is subject to litigation. What rate to apply? As I said, rates in force, 115A, for example, treaty rate or rate as per the Act is say 10% for royalty interest, for royalty dividend, royalty FTS. For dividend, the rate is 20%, obviously subject to the treaty benefits. So again, as I said, payment or credit, whichever is earlier, and the paid basis. These are the judgments which I said are favorable, including Bombay High Court, where it says that it is to be TDS to be deducted on paid basis. Now, to tell you a background of these, all these cases where actually the position was not taken at the time of making the payment or making the provision in the books. It was later on that it was realized that when tax was actually not deducted at source, it was just a way out which we thought that we interpreted the treaty in such a manner that the wording in the treaty is paid, just to avoid or just to overcome the interest in the penal consequences, right? But if I repeat, if you are at a planning stage, you are at a risk to take this view. Again, as I said, Transmission Corporation and GE Technology, both the cases, Supreme Court has held that only when the sum is chargeable to tax, you have to deduct the tax at source. Otherwise, you are not supposed to deduct the tax at source. So again, a snapshot. If entire payment is not chargeable to tax, I am not required to deduct tax at source. Simple. If entire payment is subject to tax, I need to deduct on the entire amount. Part payment subject to tax, tax should be withheld on appropriate proportion of sum chargeable to tax. Part payment subject to tax in India, payer unable to determine the proportion, obviously you have to go to the AO to determine the amount of TDS. For example, simple example of purchase of property from NRI, capital gains, right? He will say indexation is available, this is my cost of acquisition, etc., etc. Can I blindly rely on that? The answer is technically no. People are relying practically, but technically, if you ask me, that is not the correct approach. You need to approach the AO and get a lower withholding from the AO. Payer? Yeah. No. Enough. Yeah. 15 lakhs, you need to check whether I am coming to India for 120 days or more. That is also important. So if I am coming to India for example, my stay in India is 150 days, right? I am coming to visit on India for 150 days and my income is more than 15 lakhs. Then I am RNOR. I am a resident. I am not a non-resident. So 195 will not apply to me. I will go by the domestic tax law. Yeah. Correct. Even then, so see, if you look at the condition, 120 days or more, the second condition which is to be satisfied, 120 days or more plus income more than 15 lakhs. If this criteria is satisfied, you become an RNOR, you become a resident. Once you become a resident, this is not applicable. In fact, you are better off there. 194 IA will apply 1%. Right? So I would want to be an RNOR to come out of 20%.
Are not considering on the purchase value.
Yeah, people are deducting on gross.
And that to long term.
Yeah. That is the best approach. But practically, सामने वाला धमकी देगा, फ्लैट नहीं बेचेगा. 30 days में you get the lower withholding. The only thing is people have that fear कि tax officer के पास जाएगा, वो कुछ निकालेगा. But you get that in 30 days. Practically, we have seen you get specifically for these capital gains on flats, etc. You get within 30 days. If you follow up, yeah, you have to file form 13 online, but physical visit लगेगा. सब online होगा नहीं. Because AO के पास limited काम है, physical आपको मिलने का, चाय पिलाने का, तो बुलाएगा आपको.
Payment of rent to
Yeah.
property is owned by non.
Yeah, 30%. So next is rate of tax. As I said, treaty or act, whichever is beneficial. I'll wrap up in next 10 minutes. That's why. So rate of tax, as I said, treaty or act, whichever is beneficial, assuming act is 10% or 20% and treaty is 10%. Whether surcharge and cess will be applicable on the treaty rate? The answer is no. Treaty rate is the final rate. You need not apply surcharge and cess. अभी आप बोलोगे department करता है, but that is their problem. उनका software करता है, that is their problem. There are judgments to suggest or to consider this view that no surcharge and cess on treaty rates. Payment of royalty, FTS effectively connected with recipient's P, TDS at the rate of 40% and on net basis at 10% on gross basis. Right? So it will be on 40% on net basis. Now practically when you say net basis, it has another catch. When you say 40% net means you have to maintain books of accounts. If you have a PE in India, you have to comply with all those conditions. And if you don't comply, then effectively you don't get deductions also. So therefore, ultimately in most cases, it ends up 40% gross. Right? Exceptions to 195, one quickly, 192 salary and all those other taxes where 5%, 10% is specified under the act itself. Grossing up, again, I quickly directly jump onto the example. What do you mean by grossing up? That you have net of tax arrangement. मुझे $100 चाहिए, $100 चाहिए. Whatever is the TDS, you bear the TDS. So effectively in that case, I have to gross up. It means 100 becomes 90, right? So therefore I gross up and ultimately 111.11 becomes the gross value and 11.11 will be the TDS. And I have to pay the TDS from my own pocket. Yeah. 195.2 is basically where an application can be made by the payer for lower withholding. Right. So there are two options, 195.2 and 195.3. 195.2 says payer can also opt for the lower withholding. Can he opt for nil withholding? That is a point of concern. There are judgments. Few courts have held that yes, you can apply for nil withholding also, but if you read the Kolkata High Court and also GE, arguably it says that 195.2, the payer cannot go for nil withholding. If you want to opt for nil withholding, you have to ask the payee, that is the recipient, to claim or to file Form 13 in 195.3 or 197 as the case may be. So this is a snapshot of 195.2, 195.3 and 197. I think this is self-explanatory. You have the soft copies, I believe you can go through it. So just a snapshot or by way of a chart, 195 in a nutshell. Taxable under the Act, no DTAA, you deduct as per the Act. If there is a DTAA, then TRC and all other documents, whether available. If the answer is yes, you deduct as per treaty. If the answer is no, again you deduct as per the Act. And then ultimately make the remittance. 206AA, quickly. If you don't have a PAN in India, the higher rate is applicable, that is of 20%. Plus surcharge and cess, of course. That is another debatable point, whether surcharge and cess is applicable on 206AA or not applicable. Right? So the higher rate applies. However, there is a benefit available for non-residents. Now, arguably, 206AA surcharge and cess is not applicable, right? Because if you look at the provisions, etc., and interpret it, 206AA में surcharge cess नहीं लगना चाहिए. Specifically, Rule 37BC. This is where we were talking about कि 206AA is not applicable to non-residents, provided you furnish the TRC and the details in 10F, that is name, email ID, contact number, address, TIN number, etc. Only if you provide your TRC in Form 10F, then you will be eligible to claim the benefit of Rule 37BC. Otherwise, 206AA will be applicable, right? So the question which was asked that if I don't have a PAN, it's okay. If you don't have a PAN, TRC should be there, 10F should be there. If you don't have both, 206AA will trigger, as simple as that. No relief. Key aspects for 15 CACB, quickly. Whether the amount is chargeable to tax, if the answer is yes, amount exceeds 5 lakhs, yes, then you need to issue Form 15 CA Part B plus Form 15 CA Part C, or effectively Part B or Part C, or Form 15 CB, that is from the Chartered Accountant. No, then only you need to file Form 15 CA Part A if the amount does not exceed 5 lakhs. If it is not chargeable to tax, that is exempt, or not chargeable to tax at all, then you need to file Form 15 CA Part D. CA certificate not required. No information to be furnished if remittance is by individual towards current account transactions, specified remittances, right? So this is the snapshot of 15 CA, 15 CB compliances. And this is the process. Remitter obtain certificate from 15 CB if required. Then you generate 15 CA. You all know much better than me. I have never generated even a 15 CA single time. I don't want to take that risk, to be honest. So key documents to be maintained, because this is important, because once you withhold the tax at source, you should take these documents on record. Ultimately, assessment ke time ye sab documents kaam aayega. And when it is questioned that why have you deducted at a lower rate or 10% or treaty rate, that is agreement, invoice, no PA declaration, TRC, declaration about the beneficial owner, because in the treaty you have this beneficial ownership test also nowadays, also considering the MLIs. Opinion or advice obtained from consultant for lower rate, whatever. Exchange rate letter, SBI DT buying rate, and CA certificate in Form 16 CB. So these are the key checklist of documents. Again, this is not exhaustive, suggested list. Consequences of non-compliance, you know better. 201, 1A notices, prosecution also, plus disallowances under 40 AI for non-resident, of course. I think that's it. Key takeaways, need to be mindful while dealing with NRIs. You need to understand the law. Check the residential status as per income tax. FEMA is of course from an overall perspective, but as far as income tax is concerned, tax is relevant. Check taxability of various income, dividend, interest, rental, capital gains, and royalty FTS. These are the main stream of incomes. Payments can be remitted under alternative mechanism, CA route. That is, you can obtain CA certificate and not go for lower withholding. Again, subject to litigation, but possible. In case of doubt or substantial amount, it is advisable to go to the tax officer and obtain lower withholding, nil withholding. Don't take it on your head. Mitigate against severe consequences. We just saw in the earlier slide, disallowances, etc. Tax withholding from cross-border transaction is critical, of course, because nowadays insights portal and everything is going digital, and information is available with the department very easily. You might forget, but you might remember, "Arey, maine aisa kuch kiya tha," when you receive the notice, right? Consult an expert if required in tricky cases where the amount involved is substantial, because again, dealing with non-resident is when you are dealing with foreign companies, etc. And if you are not aware of the law, etc., be vigilant to approach any expert. So therefore, I think that's it from my side. If you have any questions, else we. Yes, sir.
One of transaction FTA, RTA royalty to do NRI company to file return.
See, there is an exemption from filing of return if tax withholding is done. अगर TDS काटा गया है तो जरूरत नहीं है रिटर्न फाइल करने. सिर्फ मेरा इंटरेस्ट इनकम या यही इनकम है, इंटरेस्ट रॉयल्टी एफटीएस, तो मुझे जरूरत नहीं है. अगर TDS काटा गया है ठीक से है तो मुझे रिफंड क्लेम करना है तो ऑब्वियसली मुझे रिटर्न फाइल करना पड़ेगा. Yes, sir.
Solvent or freight.
Correct. A very common point that we attend various exhibitions at various, overseas jurisdictions and freight charges, etc. So this particularly, to my mind, will be a business expense or a business income rather. And in absence of a permanent establishment in India, it should not be chargeable to tax. So therefore, no withholding. Because ultimately, if I am into the business of arranging the exhibitions, etc., it either can be my business income or it is lease rentals at the most, if it is for the premises, right? So even if it is for the premises, the situs is not in India, the source is not in India. So in absence of P, not taxable, not chargeable to tax, so no TDS. So you have to get the tax credit if you are a resident in India, and you have to get the tax credit. There is specific form called Form 67A, 67 rather, which you need to claim, or which you need to file along with the supporting documents, like you have to get the TDS certificates from there and the invoice copy, etc. And you need to file Form 67 before you file the return amount. Many times what happens is you miss filing Form 67. So therefore, you may not be getting the credit.
And how much credit will be?
See, the credit is, in India, we follow the credit mechanism is basically proportionate to the income which you are offering it to tax in India. So assuming you are offering the entire income to tax in India, you can claim the entire TDS. But if it is a proportionate income, then obviously it will be proportionate. I think that's it. Thank you. Thank you very much.
So thank you, Vyomesh bhai. So with the round applause, we really appreciate the views of Vyomesh bhai. This topic itself, it is a subject, and covering it within just 2 hours time, we can understand the efforts and pain you have taken, sir. You have really touched upon, you have brushed upon the important provisions, treaties, and the remittance related 15C, 50CB provisions in a very limited time. So now before we propose a hearty vote of thanks, there are a few announcements. Yesterday, as we all know, the members, they have taken a large benefit in our mega blood donation in the health checkup camp and made this event very successful. But because of any reason, if any of the members, they could not take the benefit of this camp, the lab with whom we had tied, they are ready to take the samples from the residents of the members. If anybody of you, if they wants to take the benefit of this camp at the same price, they are going to offer the same tests. So we'll share the flyer with you, but this benefit will be open only for 1 week. So we'll share the list of tests, what they are going to cover and the prices, right? But it will be on the same price which were there for yesterday. So please take the benefit. And this is open for all. It is not only for the members, for your family members, your well-wishers, anybody can take the benefit for entire 1 week. Second, our next session, it is on the LLP. There is a paradigm changes in the LLP provisions, reportings and filings and all. So the second sessions, we have the speaker CS Raj Kapadia sir. So he's also going to enlighten us on the very important provisions on the LLP. So we request all the members to be there after the break. And now it's time to propose a hearty vote of thanks. So I would like to invite our Deputy Convener CA Purvi Bagheria ji to propose a hearty vote of thanks to today's first speaker.
Morning, everyone. First of all, excuse me for the very bad throat I have today, a little infection in my throat. I would like to propose a very hearty vote of thanks to our today's speaker, CA Vyomesh Pathak, on behalf of the entire JP Nagar CP Study Circle, for his very interesting, very detailed and elaborate session on taxation of NRIs in India. So you very clear, you've covered all the topics very nicely with proper illustrations, helping us to understand the nitty-gritties very even in a better manner. And thank you so much for taking all the queries of the participants. And that's all. Thank you. And I invite all of you for the break.